Netflix stock has gotten hammered down around 50% from its recent high after they reported their fourth quarter 21 results. The stock fell about 20%. It's continued to get bludgeoned. Investors are wondering, should it get the red light or green light? Should investors scoop up this dip, especially given that this stock, Netflix stock, NFLX, has been one of the best performers over the last few decades, up tens of thousands of percent. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Netflix. I did not own stock in Netflix. And so Netflix stock has gotten hammered. As I mentioned, following its fourth quarter 21 earnings update, it fell around 20% on weaker than expected results, and it's now down about 50% from its all-time high just a few months ago. Despite this recent tumult, it's worthwhile to have some perspective. Netflix has been one of the best performing stocks since it IPO'd in 2002, up tens of thousands of percent. And this is as of 12/31/21. So the stock is a bit down since then, but still, up thousands of percent, significantly beating the indices. And probably a good reflection that despite whatever tumult you're facing, if you have something that you think will compound for long periods of time, it's about the time in the market versus trying to time the market. So that is something, it's worthwhile for investors to consider. Volatility is cost of admission, arguably, when you look at a business like this. So the billion-dollar question is, what does the return look like from here? And why is it down so much in short order? And so why did Netflix get battered? So management has historically been able to underpromise and overdeliver, and that's what you want to see. You want to see, conservative outlook and beating it. And in the fourth quarter 21, they overestimated their global paid net adds by around 200,000. So they said, hey, we think we're going to be able to add, around 8.5 million, but it only came at 8.3. And that's one of the red diamonds that you can see periods where they underperform. Generally, where they miss, it's usually just by a little, but when they hit it and they hit it out of the park, you can see it's by, these green diamonds generally are much better. So history, I'd argue, and look, putting a chart together like this does show that they're mindful of how they perform. And similarly, their growth outlook for the start of 2022 is also at a depressed level, relative to prior years. And they're saying, look, you can see how our weekly global paid net adds year to date is trending slower than pretty much any recent year to date. And the problem also is the fact that you had such a strong demand pull from 2020 that might have resulted in slower growth in 2021 and 2022. And it's also interesting to see which regions are driving their business. Arguably, Netflix has really become a global business. For example, Asia Pacific saw a 27% increase in revenue, while Latin America was up 22%. EMEA, or Europe, Middle East, and Africa, was up 18%. So pretty much everywhere outside of North America, putting up really strong growth, around 20% plus. But you look at North America, which they call UCAN, or United States and Canada, only had around 11% growth, but this was mostly due to higher prices. The paid memberships only grew around 2%, so clearly North America is much closer to saturation. You can see the paid members grew from around 74 million to 75 million year over year. This sluggish growth, and keep in mind, they're guiding to around 10% year over year growth in the first quarter 2022, so nowhere near hyper growth. This sluggish growth is a bit concerning as well, given that Netflix has many of the top searched TV shows and movies. So, folks are saying, well, wait a second, you're guiding to slower growth despite the fact that you have many of the top slots for TV in terms of most searched for TV shows and two of the top 10 movies that folks, were interested in 2021. What happens in a scenario, where they don't have as many hits or there's tougher competition? What happens to their growth profile, if there's tougher competition to win here? And it's clear that the streaming competition has definitely gotten tougher. Netflix is not an unrivaled value proposition, but they clearly do have an incredibly strong offering. Maybe in the last few years they were unrivaled in terms of, having a streaming service that just had a lot of options, but now it's clear that there's a lot of players in the space looking to compete. I'd also argue they have a potential competitive advantage as their scale, looking at a global operations, allows them to afford more bets where they can make, say, hey, let's green light more shows that might be risky, that might not actually get, a following, but we need to be taking risky bets to see what can be a hit. Let's try these $20 million one-off, Korean shows, and let's see what can happen. And by the way, if you have a hit in Korea, maybe you can leverage that content, with good subtitles, and it'll be a hit internationally. internationally. And arguably, that's what you saw with Squid Game, which was an international bet, a dystopian Korean thriller, which was the biggest TV show of the year. And in the first 4 weeks generated 1.65 billion hours viewed. Just think about how many eyeballs and how strong that arguably makes their subscription when you have that many people tuning in and say, hey, this is quality entertainment paying a reasonable price. And it's rumored to have cost only $20 million to make it. And despite concerns of tougher competition, management clearly believes they have a strong value proposition, as they recently announced their intent to raise prices another $1 to $2 per month, depending on the plan. I mean, this is one of the key traits of a company with a very strong value proposition, the ability to raise prices with broad customer acceptance. For example, look at Berkshire Hathaway See's Candies, different business model, but look, they raise prices nearly every year by a couple percent because they know they have such a strong brand, and I suspect Warren Buffett just likes raising prices. And so what about the valuation? Should Netflix stock get the green light now that it's down so much? First, a quick plug where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com, click join the journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's unrivaledinvesting.com. Click join the journey. And if you enjoy videos like this, please make a point of hitting that thumbs up, hit that subscribe button. So in order to value Netflix, one should first understand that management is playing the long game. These are effectively operators that have been running the ship for a long time. These are, Reed Hastings, founder of the business. So it's about getting to scale over time. So that means operating margins inch up each year. And this is a big reason why you can't value a company like this on PE ratio, because the E is significantly under earning for a lot of these years relative to what they will be at in the future. And so if you layer on revenue growth plus this margin expansion, their actual earnings grows much faster. And that's the reason why in my models, I always think, well, what's the optimized margin that you think you'll be at longer term? So that way your delta between where it is today and the future is really the revenue growth. So that's why I'm thinking about this. Now, look, longer term, currently they're penciling out around 20% margins. Longer term, maybe their margins approach 25 to 30%. That's a big maybe. But despite the optics of increasing profitability, the reality is that Netflix as a business model has been a huge cash burn, billions and billions and billions of losses. I mean, this is largely because management knows that they've been playing that long game. It's about grabbing as much land as soon as possible. So they want to get as many subscribers, spend as much on quality content, build up their library, so that way they have a strong offering. Now you contrast that to how, basic accounting works, is that basic accounting will take the cost and spread it out over several years, saying, oh, you just paid for this TV show, and we're going to spread it out over how long we think people will be watching it. So they amortize the cost of the content. Whereas the cash flow statement actually tracks when did you spend that money, and you can't spread out the cost of a TV show. Generally, it's upfront payment, and then the accounting, the net income spreads that cost out. So this is why it's so important, in my opinion, to understand cash flow dynamics. And that's always one of my favorite places to look, because it does show you a lot more about this business. But I think, in my opinion, this is the right move to get to scale before others do, to ensure long-term viability, and also puts them in an advantageous position to take more bets. The bigger you are, the easier it is to take more bets. Yeah, you can have more misses, but you can also have that unexpected $20 million hit that turns into the top TV show of the year. So 2020 was an outlier, as subscribers signed up in record numbers in response to stay at home. And they generated a nice free cash flow profit, I'd argue. So, significant free cash flow. But 2021, as in many other recent years outside of 2020, was another year of cash burn. That said, management is looking to break even in 2022. So as I think about the valuation, despite the recent share price decline, I'm inclined to give it the red light, as we look at effectively, let's say you pencil out a teens level growth, certainly faster than the 10% management's guiding to for the first quarter 2022, assuming 25 to 30% profit margins. Keep in mind their free cash flow is nowhere near this. They've been a cash burn, and their operating profits at what they report on a GAAP basis isn't there either. So I'm giving them full credit for what their future could be. That said, assuming teens level growth, assuming 25 to 30% margins, assuming, let's say, 15 to 25 times earnings multiple 5 years from now, And it's just hard to conservatively pencil out an incredibly high return for Netflix stock. Like assuming all these different assumptions, and you're effectively getting to less than 100% upside. I mean, in one upside scenario, maybe penciling out 90% over the next 5 years. Now, of course, stock prices can go, let's say, way higher and lower than this back of the envelope hypothetical framework. So, look, you need to consider that if they don't perform, and let's say growth goes even lower than what I pencil out here, then of course the stock price can get hammered. Vice versa, if they're able to do a series of price increases while increasing membership, and their growth is, let's say, well above 16%, then yeah, the stock price can do much better. Or if you think they're, maybe they become a target for acquisition. I don't know who has the budget to acquire them. It'd be a $200-300 billion acquisition. But if you're looking to do that, maybe you're saying a higher end multiple 5 years from now, or something like that. And so really, if you are a mega bull with Netflix stock, you need to be able to pencil out, let's say, more than a mid-teens growth rate in the coming years. Once again, despite guiding to 10% growth in the first quarter 2022, or just assuming a much higher end multiple. While I might not ever get it, I'd be more inclined to revisit Netflix stock closer to $200 per share, and that's quite a haircut from here, just given that you're facing lower growth and I'd argue should have lower multiples because of that. And, at this point, if I'm going to pay up for a stock, I want to have something that's either posting faster growth or has a better free cash flow profile without as much debt. I'd rather look at a company that has tons of cash on their balance sheet, better growth, has significant free cash flow that they can buy back stock. So that way, if the stock were to fall significantly, they can easily buy back shares. And that's not a position that Netflix, I'd argue, is in. That said, maybe they can leverage their intellectual property. They're quickly building out their own content, their content library. Who knows? Maybe there'll be a Netflix theme park or something like that someday. They've recently started, rolling out a gaming option. I'm not really giving any credit to that here. I'm curious, to see if that will play out. If you have a different take on this, or if you feel like there's an angle on Netflix stock, NFLX stock, that you feel like I'm missing, I'd definitely love to hear it. If you're a mega bull or mega bear, please leave a comment below. And if you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.